into secondary and tertiary markets and into riskier, perceived riskier asset classes, just because people, one, need to put the money out, and two, need to get the returns.
Great. I want to leave a little bit of time for questions, and I'm going to steal Todd McGrath's, and I can do that because he was my professor. He asked what should people be thinking about, and I know a couple of people said interest rates and inflation, and if you guys would just, share with us what you think people should be thinking about, or maybe what you are actually thinking about at this point in time.
I think fundamentally it's still, we still have a pretty conservative posture. The world is no more stable today necessarily than it was a couple years ago. You get, natural disasters, you get, disruption geopolitically around the world, you get, major economies underwater. In this country, we have states underwater. And so the re-equitization of the real estate market is kind of the re-equitization of every geopolitical entity out there. I mean, there's massive disruption that's taking place, and so it's kind of hard to get really giddy about the prospects of real estate. I think, from our point of view, we probably have seen the worst. We probably have seen the bottom, but I don't think that necessarily means that the hockey stick growth curve is upon us yet either. We probably expect internally that we'll be bouncing around a little bit. Everybody says the home buyer's not there. Well, that's not true. There are people that are buying properties. They're just not paying the same amount. They're certainly not paying at the same velocity. They're not lining up around the window, and a property before it's built isn't 100% pre-sold anymore. And so I think that, if you approach your expectations with the reality that it's going to be bouncing around, you might have some, unexpected events. You might have to be, keep a little more cash in reserve. You might not want to leverage as aggressively, just because stuff is still going to happen that we don't necessarily foresee. And I think that's how you're going to protect your portfolio, and that's how you're going to protect your shareholders or your equity constituents, protect their capital and provide a safe return. If you want to take risk and swing for the fence, there's plenty of those opportunities around, but I'm not sure that's what most people are looking to own today. They'd much rather have a safe 10 than maybe a 20, because those maybe a 20s aren't around.
So I would say this can be a little bit of an off-the-wall answer, but the thing that really keeps me up at night is not this little piece of the financial cycle, because companies been through many of them and not been through many of them, and they come and they go. But yesterday I spent a couple of hours with a group of guys in Cambridge who have a tech startup company. They're all between 25 and 30. They fit into about 600 square feet. Their ideal goal is to take this company and move it someplace with an internet connection in the middle of Maine, where they can swim in ponds and hunt and fish and do the things they like to do, as long as they have a certain microsecond time between that and where they need to communicate. They have what they call a proximity housing allowance, which allows them to collectively share an apartment a couple of blocks away from their office. They're all, their oldest people are about hitting 30, and they do know about girls, but I'm not sure that they're really thinking about getting married anytime in the near future. And whatever they buy comes in a box, and UPS delivers it. I don't even know if they go down for sandwiches without somebody bringing them up. So when I think about the way these people are living, and I think about what their aspirations are, and I think about what stage of how old they are for what stage of life they're in, and then I think about the fact that I look out this window, I see office buildings, hotels, and the rest of it, I think real estate is way out of sync with the way people are thinking and living, and to me that...
Okay, that's enough out of Ed. No.
That's the problem. That's our biggest problem as a
Cocktails
company.
in the lobby at 5. No, and I think what you said was actually echoed earlier this morning, is people are doing things in their own style, and I think it's just, everything is a little bit different with technology, so thank you.
I do think that Ed hit the nail on the head. I mean, real estate was supposed to be a diversifier and a hedge against inflation. And now that everybody's consumption trends are smaller and more compact, I think those are the things that, as a firm, my colleagues and I are weighing against moving forward. So it's in the retail space, there's a lot of grocery consolidation. There is a lot of migration to urban areas from rural areas. And those are some of the things that are first and foremost on our minds is how can we react to that new environment. But as a whole, I think we just have to keep in mind that for the choices that we do make in acquisitions, it really comes down to how balanced are we as in recognizing this as asset class for diversification and as a hedge against inflation, and to move forward from that point.
I actually had a couple of last points to make. I certainly would agree with everything that the panel said. It's all great that there's tons of capital available for real estate, but at the end of the day, to me, it kind of all comes down to operating fundamentals. And I watch very closely job creation, because at the end of the day, if jobs aren't being created, then there's not going to be demand, no matter what asset class you're in, whether you're in office or retail or multifamily. And I think during the recession, there was 8 million jobs lost in this country. And I think earlier this week, the number of private sector jobs that was created in the month of March, I believe, was 200,000, which everybody said, oh, that's a great number. But when you start comparing that against 8 million lost, we have a very long way to go there. So I watch the job statistics because that impacts the operating fundamentals. The other area we touched on a little bit here is just the regulatory environment. There's a lot happening at a national level and a local level from a regulatory standpoint, even beyond Dodd-Frank, which has the potential to impact commercial real estate lending. So we pay attention a lot to what's happening from a regulatory standpoint.
Great. Well, I don't know if anybody has any questions. We'll open up the floor.
Hey, hello? I keep hearing there's too much capital out there. But as soon as I mention new development, ground up, pre-leased above 50%, whatever it is, medical, retail, everyone runs for the hills. Too much capital, but don't want to invest in pre-leased Class A items. What's going on?
I think that's a lender question there. So.
Well, my point of perspective on it is that, we don't all have that short a memory. And there are a lot of development deals where people choked heavily on them over the last cycle. And that as you look at this market, and we heard some opinions that, what's the real space demand going to be? What's the real space demand going to be for retail? What's the real space demand going to be for hospitality? What's it going to be for residential, office needs? And if we don't really know what that space demand is going to be, then why are we going to leap to create more of it? I ran into a colleague here who is active in the multifamily space, and he's dancing in the streets at the moment because suddenly that market has exploded. Everybody looks at the demographics, and all the people that have lost their homes in foreclosure are now renters. Gen Ys and the Echo Boomers, they're all basically still renters. They're postponing a buy. And so everybody says, well, that's just more demand for multifamily. And as it happens every time, multifamily will outgrow itself again. Because this business, we're all cattle. We all herd to the same hot spot. And inside of a relatively short period of time, they're going to create too much supply. I think that the challenge on other asset classes is still, prove it to me. Prove to me that the market is there for the need for that asset. And even then, the loan to values are going to be materially less than they were the last time around. And so the flip is a lot of people look at the equity requirement and say, well, the math says I get a 12 to 15. Is that really worth it for all the risk and the recourse they're going to take to build that asset? And so the equity sponsors aren't jumping into development either. They'd say, I'd rather get that same return or a little less by taking a known commodity in an existing asset rather than take the risk of a new development.
Any other questions? Really?
Thank you. I noticed that a lot of people talk about tons of capitals waiting for those deals. And we see that in the past 1 year or maybe 18 months, a lot of acquisition happened in major cities like DC, Manhattan, San Francisco. And I also see some transaction close at 5% cap rate in like DC or Manhattan. So my question is, do we have a new bubble, or does is anyone really worry about that? Because I think if the buying capital rate is 5%, I don't know how you can generate 18% IRR after several years. So, thank you.
Right, I think you're right. You're not going to be able to generate an 18% return. I think the people that are buying those core assets at very low cap rates have resigned themselves or are basically accepting that they're going to get a lower return for those assets. And in a lot of cases, you know, when our clients are out those assets, they have raised this capital, and there's a lot of pressure on them right now to put out money. And so what they're kind of convinced themselves is we're gonna overpay for this, or we're gonna pay a really low cap rate, and we'll get it on the next round because I need to demonstrate to my investors, you know, that I put out capital. It's not gonna help me, and it's not gonna help them if we turn around and have to give money back to them. So in some cases, I think some of the deals that are being done are people, you know, investors who are under pressure to put out money. And the other thing we're seeing on a lot of the core property purchases, it's overseas buyers who are perfectly good, you know, taking a 5 or 6% return on their money, because that's still better than they can get from a risk-adjusted basis, you know, at home.
And I think that's the only other thing before we wrap up. I don't know if any of you guys are involved in internationally capital, but do you see that affecting the market hugely? Inflows, you know, we talked about Anglo-Irish. Is your money in, out of the country, or?
Well, I guess what I can say is we've seen a lot of pressure on European banks. We have any way to pull their cash out. Seeing a lot of money that's coming in from foreign sources looking to invest in the U.S. But that money is mostly targeted at very few markets and the very top of the market in those markets. So it doesn't, you know, it doesn't impact the whole U.S. real estate space.
Yeah, I mean, the sovereigns have such a massive amount of money to put out, you know, measured in billions, and they're not gonna they can't do it in $25 million chunks. It's physically not possible for them to sprinkle it around that way. So what they end up doing is going to, you know, the 5 largest, you know, the Blackstones, who can raise, you know, $10 billion in a wink, because you can go put $500 million in them and you don't own the whole fund. And so the challenge is going to be, how do you get the money sprinkled down from, you know, a $1 billion chunk to AMCAP, who says, I don't really want $1 billion from one. Maybe you do, but I might rather have, you know, 10 investors at 50, because I like a diversified pool of investors, and I don't want to have one boss, if you will, that I report to. And how does that, you know, there's going to need to be some intermediaries to get the big chunks of sovereign money sprinkled to, you know, the more, you know, more common investors of capital.
Well, great. Well, thanks to, are we good? I think we're good. Yeah, thanks to all the panelists. I know some of you have